Accounting equation and Excel reversing entry related to accounts receivable cutoff. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an Accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. In Excel, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly follow along with that good old paper and pencil. If you do have access to this workbook, though, there's 5 tabs down below. Example, in essence, the answer key. Month 1, first month of operations. Month 2, second month of operations. The practice tab, having pre-formatted cells. So you can practice the practice problem with less Excel formatting. The ADJ and reversing tab, the one we will be working on, is where we started with a blank worksheet but are basically now working within a template. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to that example tab to get an idea of what we will be doing. Remembering we're constructing or building our bookkeeping system with the accounting equation, in essence acting as our trial balance from which we can and have, just to prove the point, made our major financial statements from, that being the balance sheet, income statement, statement of equity. We're now looking at the adjusting and reversing entry process. What we've done thus far: enter 1 month of data input, close it out, enter the second month of data input, and then set up our adjusting and reversing entry worksheets. Remembering that we want to keep this process kind of separate in our mind from the accounting and bookkeeping process because the objectives are different. The accounting and bookkeeping process, wanting to communicate with the people we have to deal with as clearly as possible, customers, vendors, employees, and automate the system as much as possible to make it as unintrusive as we can so that we can busy ourselves with making money in the business. Whereas in the adjusting department, what we're trying to do is make the financial statements correct for reporting purposes, typically according to an accrual basis, but possibly also with a tax basis system for oftentimes external purposes of reporting needs. So what we want to do then is take the information oftentimes out of the accounting system, like a QuickBooks or Xero, even if I have access to it, so that I can put it in a worksheet and see clearly and transparently the impact of the adjusting entries, which is doable given the fact that there's not too many of them. Oftentimes I would do this with debits and credits, but we're doing it here with the good old accounting equation. Once we enter that information for external reporting needs, then the question is, should we put it back into the QuickBooks file or the Xero file to make the financial statements correct as close to the basis that we're using as possible? If we do that, we're going to run into problems because we're going to mess up the bookkeeper. Oftentimes that's using a different timing difference than what we are doing because that's what's easiest for the accounting department to do. So we want to enter our information so it doesn't mess them up. So one way we can do that is we can do reversing entries for particular entries that are timing differences, making the financial statements correct as of the cutoff date, possibly so we can create our financial statements from the software maybe, if we want to, and then we can basically reverse them as of the first day after the cutoff date so that we go back to the timing that they're using because that works for their bookkeeping and accounting system. So this time we want to look at that concept with regards to a cutoff type transaction. So let's give a quick recap of the adjusting entry that we put in. This is probably the most complex one to think about, and it's something that might not come up all the time With small businesses, possibly, as long as you're kind of consistent, you might be okay. It kind of depends on the industry. But if you're in audit, for example, it's an audit test that you'll have to do most of the time, a cutoff type of test to determine if the income is reported in the proper period. Now, when you look at it like a QuickBooks system, for example, most of the time businesses will be on a cash or accrual basis based on what industry that they are in and what works best for their accounting system. In other words, if I'm in an industry where I have to invoice clients, then I'm going to be on an accrual system because I'm going to do the work and then invoice the clients, necessitating me to track who owes us the money in accounts receivable being an accrual account. Therefore, we're recording the revenue when the work was done, not when we receive money. When there's a difference between when the work was done and we receive money, there's going to be a difference between a cash and accrual basis for the revenue side of things. Now, it's easiest to see this problem in like a job cost system. So if you're in a job cost system, like a CPO firm or a law firm, then the staff is going to be work like crazy, right? And then the partners are kicking back with their feet up on the desk, like smoozing with all the clients and whatnot. And then you give the partner the work that you did, and so that they can then bill out the time and charge the client for the work you did while they're kicking back, sipping martinis or whatever they do over at the wherever classy joint they're hanging at. I'm just kidding. No, partners are great. I'm just kidding. You want to be the partner? I don't know. Anyway, so that's but the point is that the work was done, and then we have to accumulate that work on a weekly basis, bi-weekly basis, or semi-monthly or monthly basis or something like that. So in that case, even when I bill the client with an invoice or invoice the client, then I'm going to record the revenue when the invoice went out, but the work was done before that because I'm invoicing based on the timesheets that were done in the prior 2 weeks or month, for example. So you can see that the accounting system that we have still isn't perfectly on an accrual system. It's the best that we can kind of do for using the forms that will be generated in order to record, but it's still going to have a timing difference. Now, obviously, again, we don't want to mess up the billing process. We want to keep that the way it is and then make adjustments if we need to at the end of the year to shore up this cutoff issue, pulling the revenue for those invoices that were entered right after the cutoff, usually in January if the cutoff was December 31st, in our case in March if the cutoff in our case is 2/28, the end of February, so that we can pull the revenue back into the proper period when the work was done. Now, for our purposes, it could also be like if you're in a construction company, you can have a much more complex set of invoices because there might be materials and whatnot in it as well. In our case, we're going to use an invoice that has inventory, because just so we can add the factor of inventory. It's less likely that if you just sell guitars that you're going to have this cutoff situation because the billing, you're going to collect the revenue at the same time or invoice at the proper time. But just to deal with the inventory, which might mirror something like in a job cost system where you do have to deal with inventory to complicate the scenario rather than just have a service item, we're going to imagine an invoice went out in March. So it went out after the cutoff date because our cutoff date is 2/28. We pulled it back in before the cutoff date, not by entering an invoice, because remember, the adjusting entries should not be done with an invoice. They should be done with a journal entry because that helps us to distinguish the difference between the forms. Now, there's no difference in our worksheet here, but if we enter this into QuickBooks, then an invoice would be the thing that records the sale typically. Our adjusting entry is mirroring the transaction of the invoice before the cutoff, but we're doing it basically with a journal entry. So that makes it so this journal entry right here pulled in the revenue so that our timing difference, our income statement, was then correct, recording the revenue in the proper time frame before the cutoff. So that's great. However, the original invoice was entered on, we're going to say March 5th. So that means that if I don't reverse this one, then the revenue will have been recorded before the cutoff and the revenue will be recorded again after the cutoff, because now we have, in essence, entered a transaction representing an invoice twice for the same invoice. All right, so how do we deal with that? Well, if I'm going to put this into the QuickBooks system, then I'm going to reverse the transaction after the cutoff. So I'll put it in there before the cutoff, so the financial statements are correct according to the accrual basis more specifically, and then I'll reverse it right after the cutoff to put the timing back to the way the accounting department does, because that's the timing that works for their objectives versus the timing that works for our objectives to get the financial statements more specifically on an accrual basis. So that's going to be the idea. Now, also remember that whenever I deal with accounts receivable, if I enter this back into software like QuickBooks, I'm going to have to deal with the subledger, which QuickBooks will not allow me to enter something to accounts receivable without hitting the subledger. That's a problem, because what I'd like to do is not hit the subledger, because I don't want to mess up the accounting department. I don't want to say, hey, look, this goes into to Mr. Anderson customers' subledger that they will see when they have to communicate with Mr. Anderson, because it's going to mess up their communication process, right? So then the question is, how am I going to do that? How am I going to deal with the accounts receivable? Same with the inventory. I don't want to have to record this to the inventory. Now, in software, normally they're not going to force us to use a subledger or use an inventory item if I just do a journal entry for inventory, which means that the inventory balance to our subledger will be wrong. So let's take a look at that. If I take a look at this 4346, which is the same all the way down, or wait, now it's at before I reversed it, it was 4346. We'll look at that later. Let me first look at the accounts receivable, and then we'll take a look at that after. So then we've got the accounts receivable over here. So how did I deal with this accounts receivable issue? When I put it if I was going to imagine putting it into the QuickBooks system, I have to deal with the subledger. So one way I could do this is say, hey, look, I don't want to mess up their subledger. So I'm going to make another account called accounts receivable in the QuickBooks system, or zero or whatever, but not call it accounts receivable type of account. So it'll be just an other current asset type of account, and therefore will not have the functionality that the software puts behind the accounts receivable, forcing us to enter a customer so that it can have a subledger for it. That's fine, but it's a little ugly, because then the accounts receivable and the sub account will not be next to each other. They're going to be more difficult to group, although zero can group those a little bit more easily with their more like customizable software. Although again, it's a little bit more confusing to do that, but you can do that in there. Whereas in QuickBooks with the sub accounts, you can't really put them next to each other because they're not the same type of account. So the sub accounts don't work great. Other option, well, we could just put the journal entry into, if it was customer Mr. Anderson, into Mr. Anderson's account, and then hopefully reverse it to the same account, and hopefully be able to apply out the two journal entries as though they were like an invoice and a payment, so that they can clear each other out and so on. But it's still kind of ugly, because now you're going to have, even if you can match those two forms out so they're not outstanding all the time, it's still kind of ugly, because when they communicate with Mr. Anderson, they're going to see these journal entries, which is not what you want to see in the forms, because usually you just want invoices and payments. So we could make another account. This is what we opted for, making another customer. I'm just going to call it ZZ customer to put it at the bottom of the customer list if the customer list is in alphabetical order. And then we'll put the detail in here, increasing it with a journal entry, decreasing it with a journal entry, hoping that still we can match out the two journal entries to each other so that this doesn't mess up our reports that we run for outstanding invoices and so on, even though they're journal entries here, because we can match them out the way we would with a payment and a journal entry. Okay, so that's how we're going to deal with that one. Let's go back on over to the adjusting tab. And the other issue is with the inventory. I wanted to point out, see, our inventory here before we enter the reversing entry is 4346. If I go over to my subledger, if I enter the adjusting entry into QuickBooks as a journal entry, my notice my subledger for inventory doesn't tie out. It's off by $400, the amount of the adjusting entry. Now that's actually good that they allow us to do that, because even though it allows you to get messed up on the subledger, if you don't do it, if you're not careful, it allows us to do an adjusting and reversing entry without having to mess up the subledger. So once I do the reversing entry, this should go back to 0. We should be back in balance, and the subledger should be good to go. All right, let's go back to the left and let's see how this is going to work. So let's say this is going to be on 3/1. All of the reversing entries are always on the first day after the cutoff, which is for us cutoff date 2/28. Reversing entry 3/1. We're going to reverse the adjusting entry for invoice entered after the cutoff, but work done before. So again, the scenario is the invoice was entered in March, but the work was done in February. Therefore, we have a timing problem in terms of when the revenue is recorded. I'm going to put like an orange one next to this, and I'm going to go up top and say, let's put an orange one. Where's the one I'm going to do? This one. So, okay. So now this is kind of like a credit memo, how we would reverse this. So when you're thinking about the journal entry, how would you do it? Well, you first think about the last, I could just reverse exactly the last journal entry I did, or you can think about it as basically an invoice. What would be the normal invoice transaction, and then reverse the transaction. So normally the invoice transaction, let's just type it out here, and I'm gonna try to start with a formatting that is normal. Okay, so let's just type it out. If we had, normally it would be accounts receivable. I'm going to say it would go up with a 525, and I'm going to use debits and credits here just because when you have a more complex transaction, it's a little bit easier to see with debits and credits. If you don't know debits and credits, that's okay. We'll still enter it in the accounting equation format, but I'm going to say the credits are going to be negative in this journal entry. So normally you have accounts receivable. How did I get to that number? It was 500 sales price times 1.05. The sales tax was 5% plus 100%. That gives us to 525. The sales, the revenue, was only 500. That's what we charged for, not including the sales tax. The difference is going to be sales tax payable, which you can have the negative sum of these two, or I can calculate it as it's going to be equal to the 500 times the sales tax, 0.05, and it's going to be, once again, a negative because it's increasing, it's a credit. And then we also have to deal with the inventory. So normally I put the cost of goods sold on top was 400. That's what we saw in the subledger for how much they cost. And inventory goes down, which is an asset. Whoop. Inventory. So that's going to be negative 400. That's normally the journal entry. Now, all I have to do is reverse that now for the reversing entry, which is a similar kind of process you would do with a credit memo. Remember, whenever you do a credit memo, it's similar here. You want to think about the natural, normal transaction, and then how are you going to reverse it? Similarly, with these reversing entries, obviously we enter this as a journal entry, so we just want to think about the journal entry itself and then reverse it. So I'm going to put all the reversal on this line. So accounts receivable went up before, now we're going to bring it back down. So I'm going to say it's going to be negative of this 525. And then the other side is in sales. So the sales went up before, now I'm going to bring it back down. So it should be a negative, but I think I already have it. It's going to be a negative. So it's a negative here. So I want to make it a positive, and that'll make it a negative. So we have to bring it back down for the 500. And then the sales tax went up before, now we have to bring it back down. So it's going to be a negative for us here in terms of pluses and minuses. It's going to be negative. And then the inventory went down before, so now we have to bring this back up. So I'm going to say this is going to be equal to the 400, or actually I'll say negative of that 400. And then the other side is cost of goods sold. Cost of goods sold. Now the expense went down, but we think about it in terms of total equity went down, so this has to go back up. So I'm going to say this equals the 400. So let's see if that makes sense. So now basically the net increase now, as we reverse the transaction, is $100. And so that makes sense. Let's copy down the balance to see if this makes sense. Let's copy this down. It's still in balance, so there we're in balance with the green 0. Let's put underlines here for formatting's sake. We'll bring down the balance, baby. And then let's put zeros across the board. Zeros across the board. Zeros across the board. Oh, not there. Dang it. Dang it. Zeros across the board. Okay. Zeros across the board. Okay. And then I'm going to go into my subledger over here. And again, it was for customer Anderson, but I'm just going to put it into this customer, which is not something I would normally do in my worksheet, but something I might need to jot down on how I'm going to input it back in the software. So again, it doesn't mess up the accounting department. So I made it in this account is just for the adjusting entries. So it's going to be equal to the same thing we did to the accounts receivable over here, 525, and that should make it so our subledger remains balancing in balance. Okay, so I'm going to copy this down. Now note that if you enter this into the software, you're going to have this number here, and let's make that orange and black. And this number here, I'll make it orange and black. We'll notice that those two things will look funny because they're going to be in the format of journal entries. So it looks like here it's like, yeah, it looks normal. It's an increase of an invoice and then a payment, right? But when you add the forms in the subledger, it's not going to look like an invoice and a payment. It's going to say the form is a journal entry and a journal entry. Why is that? That could be a problem because we want to still link those two things together because we don't want all of this garbage showing up on the reports of open items like unconnected transactions or open invoices, right? So hopefully we can still tie these two things out so it looks like it mirrors the invoice having been paid, even though they're both journal entries, so they don't show up on reports when we start to generate reports for open invoices and things like that. All right, but in any case, we're at 22,626. So let's go over here and say, if I select these two, 22,626, good. And then I'll check my, let's sum it up. Let's put the underline. I also need to check my subledger for the inventory, but let's first get our balances down. Home tab font group, underline, bring down the balance, baby, equals the sum. And then my assistant's complaining, I would bring down the balances if you stop calling me baby. Who do you think you are? Okay. I just like to, it's the two B's that make it bring down the balances, baby. You know, it's not offensive. I was just saying, okay, I'll tell you bring down balances. Let's pull down. Let's pull down these. Okay. So then we've got the inventory is now at, in the general ledger, 4746. Does that tie out to the subledger? Let's fix the subledger over here with our check figure. So our check figure is going to the wrong place. I'm going to change it to make it go to the New Balance, which is a type of shoe, I think. A New Balance shoe, I don't know. The New Balance is down here. It's going to help us run better. All right, we're going to say 4746, enter. So now we're back in balance. So now the subledger ties out and we didn't mess up the accounting department. So we kept the subledger for accounts receivable somewhat clean, and we kept the subledger for the inventory clean, and we didn't throw them out of balance. So that's a good thing. And so then that means that now the financial statements should be correct as of the cutoff date, and then it'll also be reversed, so the timing is back to what it should be for the accounting department to do what the accounting department needs to do. So here's where we're at right now. So on the income statement, we've got this adds up to net income of negative 27 on the net income in the first month after. Now, one more thing I want to point out. Remember that the original invoice was entered, we're going to say on March 5th. And we reversed it. We did the reversal on March 1st. Again, you might ask, hey, look, this looks funny. You already know when the original invoice was entered. It was entered on March 5th. Why don't you just do the reversing entry on March 5th so that it'll match out the same day that the actual invoice was entered, so you don't end up with these negative balances for 5 days before the actual invoice is entered? And again, the answer is because that's going to get confusing. First of all, we might have multiple invoices. It might not just be one if this is a standard practice that we had to do this for. And so then we'd have to look at the dates for all the invoices, which would be messy. But even if we just had the one, it's going to be confusing for us to determine where the reversing entries are, because once they're in the QuickBooks system with all the other transactions that are happening, we want to be able to identify the reversing entries by saying, hey, look, they're all going to be on the same date, 3/1. They're all going to be journal entries and not invoice. We didn't enter it with like an invoice or anything, right? It's going to be a journal entry type form, number 2. And we're going to say in the memo that it's a reversing entry, possibly tying it out to the adjusting entry that we entered the day before, so it can be easily located and we can easily generate reports based on that information, so that 5 years down the road, we could still kind of see what is happening, figure it out, even though it's not fresh in our mind, which, by the way, is a good rule of thumb. You want to be thinking, oh, I'll remember this. Like, it's just like anything. Like, where did I put my keys? I'll remember that. No, you won't. You put the keys in the same place, because I can't. If it's 5 years later, if you can't remember where your keys were put like an hour ago, there's no way you're going to remember why or what you were thinking with the journal entry if you don't write it down somewhere or have a system that's kind of, you want to make it like, will I be able to figure this out 5 years later? Okay, because things change. Okay. Anyway, you get the point.